a lot. It's very complicated. The derivatives market is larger than the actual.
I remember when we were, when Russia first invaded Ukraine, we were my brother and I were going to do the same thing as you did, like to do the Russian rubles.
The straddle.
Yeah.
Yeah.
And then he was teaching me how to do it. I was like, okay. And I was like, okay, when the next day, when the market opened, I'm going to place this much, you know, so either way you will make money, right? Because at that time it was going like this. So we were like, oh, no matter what, we can make money.
Yeah, it's also very nice. Like Chegg, for example, has their earnings after market.
Is this your account? Did you use this?
No, I signed in there.
Okay, so I don't know who's.
That was signed in last time.
Yeah, so yes, but then the next morning, the market, like they closed all the rubles. Yeah. They just unlisted.
But like I was saying, Chegg today has earnings.
So this is SPY.
Yeah, this is the S&P. So you see right here, every single date is when options expire.
Yeah.
So, oh man, okay, let's first start like what an option is. So let's just open this, for example.
So what does strikes mean?
The strike price is essentially, so an option essentially gives you the right to buy 100 shares.
Yeah.
At a current strike price. So right now the S&P is at 409.74. Okay. If you buy the 410 call option, that's the strike price.
So it means you expect.
Yeah, you're betting that it will essentially go above 410.
Okay.
And the farther the strike price is, the bigger move that you're expecting. But it's also carries a lot more risk.
Yeah,
So,
and then is it which way is cheaper?
which you mean this?
Yeah, like when it goes further,
Yeah,
expiration
so you
date.
see how these, so first let me start off by saying, you know how it says here 12 cents, 13 cents?
Yeah.
You have to multiply it by 100 because that's how many that's the share
Okay,
that it represents. Yeah. So when you exercise a contract, so let's say this 410, let's say it goes, let's say SPY goes to 412, those will be in the money. Let's say you want to exercise because that's your right, you can exercise. You will essentially get 100 shares per one contract that you buy. I'm trying to the best way to explain this because I'm terrible at explaining, but I'm trying to think. Let's see. And ask any questions like that gets confusing.
So okay, so now it's 409.
Yeah, 409.71.
So if I do, let's say if I think it will go down, let's do 405.
405, then you would go to so this is the call options,
Yes.
and these are the puts. So these are the so if you're gonna say that it's gonna go up, these are the calls. So you do this, you would pick the strike price, and if you want to do puts, so you're betting that the stock goes down, you're gonna do puts, which is on this side. These are all puts.
So puts means you
You're
are,
betting it to go down.
yeah.
So these, it would be opposite. So these would be out of the money, and these would be in the money.
So what does that mean? In the money, at the money?
Okay, yeah, that's right. So in the money means that the contracts hold intrinsic, I forgot how to say it. Intrinsic, yes, value.
Yeah.
So for example, let's look, for example, at this one right here. So you see the 406,
Yeah.
the price per one is $3.49, which means $349. If you add the $349 to the 406, it gives you the exact price of the current stock price. So this means that it's all intrinsic value. That means it's all intrinsic value. Intrinsic value is good. All the out of the money options, they carry only how do you say that extrinsic value. So they don't have any real value other than besides the premium that you're paying for because you're betting. That's why out of the money options are used, like looked at so what's the word? So very risky. But
Okay.
they also give you the potential to make the most profit. So I'm gonna look.
Oh, wait. So this
It's so much
means,
to explain. It's gonna take you like that's why it's so like hard. It's like flip flopping. It's something good amount.
so for 405,
Yeah, right here.
Because if I buy it now,
Mhm.
I can literally just sell it at 409 and make like 4.
Well, in theory, yes, but the issue is, since these are expiring today,
Yeah,
their value is as good as like your break even essentially. So if you buy.
yeah.
Yeah, if you buy right now and and you exercise, you're break even because the options expire, so you're not, it's essentially free trade. But if you
Yeah,
go to
yeah.
like a farther, let's look at the farther. 'Cause this
Okay.
one is,
But do they charge fees? So with the fees, you are actually losing money.
so trading view actually, or not trading view, think of swim,
Uh-huh.
they're not free, right? Free commission.
They are free,
Yeah,
yeah.
free commission. Yeah, that's why their platform slowed down a lot.
Ah,
Yeah, that's why that's why a lot of people switched Tastyworks, because Tastyworks is for commission. Okay, so let's look at this one. So this one is March 17th, so we
Yes.
still have some time. So let's do, for example, so you see the 405,
yeah,
okay, you see how it's $1,342?
Yeah.
So the intrinsic value is only $455. So that means the rest of that value in that call option is extrinsic value. So you're essentially saying, for you to break even on this call, you would need to add whatever this premium is to the strike price. So you would need the SPY to go to 418 by March 17th for you to just break even.
18,
Yeah,
because it's 13, okay, it's 13 points and then that's $13.
yeah.
Okay, but so why?
So,
What does that mean? That doesn't mean that they think market would go up before it go down?
so this is essentially. You said, wait, what did you ask me?
So let's say now that's the price, right? For the March 17, 405.
Yeah, 405.
So they charge this much, that means there are more opportunity for the market to go higher than 418.
Yes, so the people that are buying the contract are essentially saying, I think the market is gonna be above 418 by March 17. The people that are selling this are they just wanna sell it because they wanna collect the premium.
Yeah,
And of course, they would like not for the strike price to go above past it, because then they would have to find the shares to be able to sell to those.
so if I buy one contract of
It
405,
will cost you 1,360, whatever the in between the bid and the ask. So let's just say for this sake, $1,370.
yeah, so if I pay this much,
Mhm.
I can sell it, right? I can sell the call anytime before 17 when it's
Yep,
over 418.
yep, and also, yeah, yeah, you can sell anytime you want between, of course, the market open, so from 9:30 till 4. But I know for SPY, it's different because it's a market index, so,
Mhm.
yeah, I think they go till 4:15. I think that's,
Oh.
yeah, so you can trade these till 4:15.
No, but I mean, I can trade it until it expires,
Yeah,
right? Before
yeah.
it expires.
Yeah, and, okay,
That's why it's
so,
expensive.
yeah, that's why it's expensive, exactly.
How about put?
Put is the same thing, it's just the opposite.
Yes.
So these are the out of the money. And then these are in the money, so you'll see that, 411. So you're talking about, so you need to subtract it, so let's just say 1,100, subtract 414. So essentially you're essentially saying the price is gonna go below 403. Which is still, it's a big risk, like it's a big bet you're making. So 403, and we're talking about $670 worth of value that doesn't even actually exist. It's just based off of premium.
But the price when it goes down to 405 is cheaper. So does that mean it's more possible that it will go, yeah,
Okay, so this one, for you to break even, you would need the price to go 405 minus 752.
so it'd be 398,
I think, yeah, 397 and
397.
397.50.
But it's,
For you just to break even.
How about the
Oh,
$1?
right, okay, 'cause the red, we're, yeah, so that
Yeah,
first foot,
I'm telling you, it's so hard to explain, because you have so many
Yeah,
ways,
yeah.
yeah. And I haven't even talked about like how the contracts move and the.
Yeah,
formula
yeah,
and how
yeah.
they get paid.
So how about the last column, the 1.01, what
This
is
one?
that? Yeah,
So this is just showing you how much it moved today. So this is just showing you how much that's just showing you the daily movement. This is just I think this is saying, those are the low,
yeah.
actually, the camera's in the way, that's long, but this is the
Oh, we
bid,
can move it.
this is the bid.
Yeah.
And this is the ask, so you gotta, most of the time, you're gonna have to be paying in between.
Mhm.
Okay, so this is basically saying the last sale, so what price the last contract got filled
Oh,
out.
so this is the net change. So when we see this, like all the put have positive
Yeah,
number.
so that basically just means that the stock went down today and then it made money.
Okay.
And then you can usually tell, what percent it made, so if you take $1.17.
yeah. Yeah.
So you can see how much profit it made. And by the way,
So this one times 100,
Yeah,
right?
trade.
this
You buy
one,
it?
yes, time 100.
Okay.
This option straight.
Mhm.
So let me show you an example
Show us what you did.
on what, AMC?
Yeah, the straddle
Oh, no, I did credit.
or credit, okay.
That's very hard. I think I just need to keep explaining this. Do you know about options?
No, not, I wanna learn about it, but no, not.
Okay. There's a lot, so. I guess I could just stay here, honestly. Let me change this.
Like, I know the whole idea of them and everything, but I just don't know, like, in
Yeah,
detail.
I know the idea, but I
know
don't
how-
know when
know how
I see
they work,
this.
Right, I know how they work. but-
I'm going to get some markers, so maybe you can draw.
Yeah,
I think it will help.
yeah, it's very like, I don't know, it's complex.
Right,
And they do it for a
the
reason.
idea is there, so
Yeah,
how to read it is what I don't really. How to read.
once you understand it, though, it's very easy, like, oh, you're like, okay, got it. But there's a lot of weird things that go into it.
Mhm.
Like, actually, trading. Like implied volatility, all that, so. What is this? Okay, so you see this right here? See open interest?
Mhm.
This means essentially how many people are holding the contracts. Like how many are open. And then the volume is just how many people traded it today.
Right,
So just because people traded it doesn't mean that it's open. They could have just quickly bought it and sold it off. And of course you have the open interest, and that's how many people are holding the option. And that can usually be an indicator of like what the market sentiment is. Like, oh yeah, people are,
right,
either people or institutions are betting that this is gonna go down.
Right.
That's not always the case, but.
right. Did you usually wanna like kind of like hop in with them?
It depends on how far, like what I've noticed is the farther out, open interest is like larger, I'd say, yeah, like that's a good indicator, but not close range.
Right,
There's a lot of reasons for people to do a lot of open interest in the close range, but like farther out, like yearlies, like if I do.
So options, does it work for like everything? Like.
Yeah, you could- Yeah, you could do, well, it all depends if, sometimes
100 contract or 100 shares.
per contract, yeah. And yes, there's some stocks that don't offer because they're just either too small of a company or whatever it may be, but you can buy options on currency, silver, commodities, you can buy it on interest rates, you can buy it on just about anything.
Right.
The derivatives market is huge, but it's also like, this right here is very risky, like
So is it like faster? Is that what the,
this, yeah, it's very fast. I'm gonna show you guys an example
yeah, an example.
of what happened to AMC.
Do GNS right now, because GNS is like trading. Or like check out GNS.
I don't remember this unless,
This is like, it went up from $5, like I'm in right now, I have like $800.
I remember, when was this? I think this is,
It went up from $5, I caught it, it's still going up, like it's testing its resistance.
they have options, they do.
Ooh, here.
Spreadsheet.
It's like kind of old town, would say, but it's kind of high right now.
So. You know about gaps, do you? Know about gaps, like these right here, these like. This gap right here, this gap right here, this gap,
Yeah,
those usually like, they usually get filled, like the percentage is like 90%. If you go to like Apple or any like big tech stocks, you'll see them almost get filled. Sometimes not like quick, but it's a good trading plan, like, oh, there's a gap here.
oh, she might need to.
Yeah, I got it.
This is,
Oh, she said that he was inside,
$7. Yeah, it's still going up.
Yeah,
Yeah.
low caps and like mid cap stocks have been doing really well lately. Just like random stocks like Carvana, all those.
Well, Carvana, I don't know. I'm conservative in that way.
Carvana?
Yeah, I'm conservative in the way that if the company is like having cash issue or profit,
Yeah, same.
then I'm not going to,
Sure, you guys are.
I'm trying to see what like companies I should plug in this week. I'm trying to like do shoot. Maybe I'll do options. But I use this account like this. I just use the app on my phone.
Well, what broker is that?
TD Ameritrade,
Okay.
it's still the same thing. That's the thing.
so see this one,
Okay, so I'm gonna show you guys.
this is going up. Right, from the chart,
These are the options.
yeah.
So this is an option
Option.
on AMC. Hold on, there we go.
10-day, oh. This is the, okay,
Okay, perfect. Okay, so you see how the low here was 377?
yeah,
Let's just say $4. Let's say you wanted to buy 200 shares. Okay, that's $800. Let's just say it, $4, okay? All right, cool. So we got that. And let's say you wanted to buy $800 worth of options at 6 cents. I don't know how much that is. Can someone do the math?
806 at
That's
48,
$6. So
48.
is it?
By 100 at 6 cents.
$6, and you said $800, so that would get you 133 contracts.
Oh,
Double marker, right? Yeah. Strike this 7. Okay. So. We got 132 contracts, remember we said one contract equals 100 shares. So you do 132 times 100, and that's hypothetically how much, what your right is to exercise. So
Does that mean like right to exercise?
basically, you could buy the call. So I should put the strike price. Let's say you got a strike price of $7 and the stock went to $7.50. You can essentially, you have the right to buy the stock at $7 and the spread, so cents will be your profit. A lot of the times it's just the thing that you're selling the contract or whatever the premium is.
Right.
But some people like to actually own the stock, you know, like big retail investors and stuff.
Right.
Yeah, that's their whole plan, so. But anyways, we got that.
but what do we profit if I'm
Yeah,
not
I'm
going
going
to?
to show you right now. So that's why I want to see, I want to show you guys the difference in profit margin if. Okay, so you guys can see here, right here, the high,
Yeah.
see how it says 66,
Mm-hmm,
let's just say 60, just to make it even number, so that's
Okay.
10, so that's 10x, okay?
yeah,
So you made 10x on the $800 investment That's if you would have hypothetically sold on the top and everything like that. So you have 10x contracts went from 0.06 to 0.60. Okay. 8,000, and then you had 200 shares of it, and then we went to, what was the high, like, let's just say 650, okay?
Okay,
So we went to 650, because that's also when the options were right here, that's when the options were the most, because remember,
Yeah.
you gotta count for decay, but anyways. We have now 200 shares. $4 to 650. So that's 230. So you made it $500. Basically. You see the difference? So you made $500 on your $800 investment if you would have just bought 200 shares. Because that's just the difference in when you bought.
yeah,
But this one, you spent $800 on $6 contracts that had a February, what was the expiration? February 10th, so this week. February 10th expiration, and they did 1,000%, so your 800 turned into 8,000.
why would it go to 100%? Oh, is it?
1,000%?
Yeah, 1,000.
Okay. So let's see, I said 7. Okay, so the reason that it went to, like right now, if the stock or if the options, if the stock were to stay at 663,
Uh-huh,
those options would expire worthless. But since we had so much time between the expiration and thing, that movement in price created value and it cost premium for those contracts. So, oh man, it's so hard. So these options right now, if they closed, they would expire worthless because they're out of the money. No, we're not at $7,
yeah,
so they would go to 0. But since I forget what date, what's the date on this one?
February,
I don't know what day this was or what week. Okay, so this was February 3rd, if the options went to this price. So they still had 7 days before the options expired. So the options still had value left in them. And then with the huge price movement, which was from $4 to $650, which is a huge move compared to just to
oh,
stock.
so that's the option price.
Yeah, that's the option price. And
Oh,
then,
I see,
and this is the stock.
okay, so I
Yeah.
got it now.
what was I gonna say? What was I gonna say?
So you can sell the
This is where I
option.
have, yeah, this is probably where I have to explain delta and all that.
Salah talked about Delta before. Do you remember? Remember Salah talked about Delta?
Oh, yeah.
He's not at school, like he doesn't, he's not registered
Oh.
any classes this semester.
Oh.
I just looked him up
Oh,
because he didn't respond my text.
yeah, no, neither.
Yeah, so he's not at school now.
Yeah.
What's the name? Down. All right. Okay, you see where the delta says 0.45? Right here,
Yeah,
that means for every dollar move of the stock or whatever it is that you're trading, means the options price will go up by 0.45, so that's $45. If you look at the current price, that's almost 100% for a dollar move.
so the higher the delta is, the riskier it is.
Actually, the higher delta is, safer it is. As you can see, you see how the delta here
Yeah,
is 0.97, 0.97, but these are all in the money. Because they closely mimic the stock because of the, what's the word called again? Intrinsic value.
intrinsic,
Yeah, because they hold basically all intrinsic value, so they're gonna closely remember the stock. Essentially, what this means is for every dollar move, you have essentially 86 shares mimicking 86 shares.
Oh.
Yeah.
Okay,
So let's say we get this one, right? 0.19 delta,
very risky.
yeah, for every dollar move, you still make 100%. But one, it's way farther out of the money. And the theta is going to be way more. So you see how it says 0.07? But the options price is way less than the others, so it hurts more. 0.07, 0.07, 0.08, 0.08, 0.08. But these are all worth a lot more than farther out of the money.
Could we go back to the SPY?
Yeah,
So let's say now it's 410, right?
the SPY, yeah.
And I think that if I think, let's say from the chart, I think in let's say 3 weeks, I think it will go down to 390. But in the long run, it will go up to 425.
Okay, so you just wanna play the downside for the near term, so for the next 3 weeks, right?
Yeah,
So next 3 weeks, hold on. 10, 17,
20.
24.
Yeah, 20, let's say 24. So I think it will go down lower than 410, so 390,
So you think it's going to go to 390?
yes. What would you recommend us to do?
See, that's where it gets tricky, because it all depends on how. That's where it gets all tricky, because then you've got to be almost confident in, which a lot of people aren't, right? Like nobody really knows where how fast they're gonna go. That's why you always want to be a little like extra cautious, like, always.
Yeah, so what if, how do I make, if I'm right, how do I make the most money? But if I'm wrong, I know I will only lose this much.
Okay,
What kind of strategy I could set up?
so the first thing is, if you think it's gonna be 390 by 3 weeks, you probably shouldn't even, probably shouldn't do exactly 3 weeks. You might want to do a little further, you know what I'm saying?
Yeah,
So you
yeah,
might wanna
yeah.
do 2 weeks or a full month. So
Okay,
March 17th.
let's say March 17.
Okay, you think it's going to be 390? Alright, so still not, to me, it's still not even worth it.
Is that worth it?
No, I'll tell you right now. So you see how it's 570 right
Yeah.
now, the price? And you think it's gonna go 390, right? Those contracts by expiration, if it expires 390, it will be worth $1,000 each. So you will make 430 on each contract.
430?
Dollars, yeah. So essentially, I don't know what the percentage is that, but it's almost 100%.
How much
Because you're
would I
paying 570.
times
570 times
100.
100, yeah.
So it's 500.
$570.
okay? And then
And if it hits 390 in those 3 weeks, you get the 430 profit each contract.
That's right, thank you that you mentioned that. Now, if it, like you said, if it goes exactly 3 weeks, you still have all that extra time, and there's still extrinsic value in your contracts, you will make a little more. But once you get further in the money, it's all intrinsic value that's left, really. So,
if it goes down to 380, I will make more.
yeah, more, exactly.
Because I can sell it, like, I can sell it anytime before it expires.
Anytime, yeah, like you could buy this right now, right? Pay 570, the SPY could go down $1 or $2 today, and you'll be up, let's say maybe 20%, and you can sell right there if you want.
But what if I'm not sure? Like, I think it will go down, but if it doesn't go down that much, then it will go up. Then
Okay.
what should I do to protect my investment? Like, if they go up,
Mhm.
can we also get put at like 415 or 420? Something like that?
Mm-hmm.
So, like a straddle,
Yeah,
You could do that, but then you gotta remember that your upside has to be so great that it also covers the
Downside.
loss of your put, yeah, so. Let's say in a month, like you said, it goes to 290 or whatever it may be, like we said, these contracts only make almost 100%, so they don't even make 100%, so you would be down. On the opposite side, your put would still be down a good amount of money, so you would lose on this trade.
yeah,
Not a lot, but yeah, you'd still
like
lose.
$500.
No, you wouldn't even lose that much.
Oh, because I can sell it.
Yeah,
I
and
can sell
remember,
it and then,
you have $430 worth of value here.
yeah, so if it.
Add it on top.
No, yeah.
I
So-
see.
Like,
I only
for
put,
example, like I
only
said,
put
credit
the minimum
spreads,
amount, so.
the credit
the
spreads
minimum
protect you
amount,
from sideways movement.
My
Did
account.
will you be able to draw it?
Oh, yeah, okay.
Yeah,
Yeah, true.
Let's do.
don't draw there. That,
Right here?
draw here,
Okay.
yeah, because that screen is not for
Let's do,
credit.
yeah, credit spread, so what do you think, what's your? You think it's gonna go up, go down, let's say the next month.
I think it will go down
Go down.
first. And then it will go up. But I don't know when. I think, let's say before the next FOMC meeting, it will go down.
Okay, so
And
that's.
then we don't
still
know.
got- You got
2 months.
2 months, right?
Yeah,
Okay, so. You can get, so March 17th, let's do April 21st.
okay.
Let's do,
Now it's 410. Let's say, yeah, 395 or 400. No, 400 is too easy. Let's see. Yeah, it was just 400 a few days ago.
okay, we can do this one.
Or 10.
Okay, so your target is 390?
Yeah,
So you're bearish.
yes.
Okay, so you're gonna do this. What's your upside target? Like, you said you're gonna.
410, 420.
Okay, 420.
Yeah, because there's a pressure there.
Which is 79. Okay. So the 422, no, 424. Okay, the C just stands for call. So what you're gonna do is you're gonna sell the 422 call
Okay,
and buy the 424 call.
okay,
So the spread that gives you. This one's gonna get you $838 in premium, because that's what they pay you for the contract. And then once you buy the contract, it's 748. Minus. Spoiler. Okay, so you see the difference in these two? So you
90.
get credit 90. Then. This is so hard to explain. So you get credit 90. Okay, but see the spread between these two? They're $2, right? So your maximum loss is. Maximum loss is $200.
Okay,
But all the price has to do, what did we say this was, April? Yeah,
Yeah.
April 21st, all the price has to do is not go above this. By that time frame. So you said you were bearish, correct? So it can go down as much as it wants. And you're,
So if it go down to 390, how much would I make or how much would I lose?
so your maximum gain, I should have mentioned this, is $90. That's your maximum gain. The whole point with this is that you're essentially playing it safer in terms of like sideways action, where you're not sure where the market is going. And you get to benefit off of the premium.
So
Not
can
premium,
we,
the theta.
can we do, put in the same way?
Yeah, so.
So how do we do put in the
So
same way?
if you're buying calls or if you're doing credit spread on calls, you're essentially bearish. And if you're buying credit spreads on puts, you're essentially bullish. So you don't want the price to go, for example, you don't want the price to go above this one.
Okay. So if I think it will go up to more than 420,
Then
I should get something at like 405. I should get put at 405.
yeah, you want to get puts,
407.
yeah. And then you want to
Like
make sure the price doesn't go below it. You know, if you see that the price is getting a little iffy, then you might want to cut your losses. You know what I'm saying?
So in this case, if it go down to 390, how much I can make?
This one, in this case,
Yeah,
it maxes $90. Yeah, that's all you're making. So
okay,
So let's say, for example, you sell 10 of these. Right?
Yeah.
Let's say you buy 10 of these and sell 10 of these. So you get paid $900. As soon as you make the transaction, you get $900 credited into your account. So you'll see $900, you're cool. But then you have to put up $2,000 in collateral. So that $2,000 has to sit to the side a little bit. It's essentially the broker's like security, like you can't, like it's too dangerous for them to just let you have $900 and then they have no collateral. Because this is your maximum loss, so you have to put to the side $2,000.
that's my maximum loss.
That's your maximum loss, right? Now, the reason it's not,
How would I have the loss?
if the price goes above this. If the price goes above 420 or like in the middle, so 423, you're gonna start realizing some losses. You'll probably be you'll probably break even in the middle here. And as soon as it goes above the contract that you bought, that's when you're gonna start receiving losses.
Yeah, this I don't like.
These, yeah,
Yeah, I don't make enough.
no,
Right.
I agree with you. That's why a lot of people don't like them.
Yeah, so why do people choose this?
They use this because in terms of when a market is going sideways, like there's nothing really happening. Also, people do this for like a year out because that's where the premium is the highest. Like that's where the premium is nice. People don't usually do it short term, like even April 21st, that's a little short term. Might want to do it 3 months out, 4 months out. But people do this honestly because it's like a more passive way of buying options. You just buy it and you sit there and you just gotta look in your position, you know, you set like an alert, make sure that the price doesn't go. And every day that goes on, you're essentially become more safe because data is killing those options.
Okay, so let me ask you another question. So if I believe it will go down to 390, very minimum chance it will go up to 420,
Okay,
okay? What should I do to maximize my profit?
if you want to maximize your profit, then I would definitely say some sort of options. It all depends, you know? Like for example, right? If you were to want to go short right now, what would your normal position size be? So let's say you do 1,000, right? Let's say you just sell 1,000 shares, well, then you might want to get 10 puts, right? Because everyone's 100 shares.
So
So
how
that's
much,
essentially the
how
same
much is
position.
how much is the 10 contract of puts?
Puts, or what's the? So.
1 month, yeah,
Right?
this is good.
Is this where we were?
Yeah,
March.
this is March.
I think it was March.
But this is like so 395.
Yeah, it was March. Okay, perfect. Yeah, the contracts were $560. Okay, so 10 contracts of these, it costs you $5,600. So that would essentially
$5,000,
$600, yeah,
so you give me
That would be-
1,000 share,
that would mimic 1,000 shares.
yeah,
You gotta remember that these are out of the money, so. All that value right there is, what's the word called? Starts with an H.
intrinsic,
No, it's extrinsic value, so this has, if, the price just stays the same and it doesn't move. Every day you're losing value off those,
why?
because of theta, because that's just time decay, since
Okay,
it's all extrinsic value, that value is going down every day. So you can see the theta right there, it's at 0.12. So you're essentially losing 0.12 every day. Oh no, I'm sorry. Yeah, 0.12. So you're essentially losing 0.12,
every day,
$12 every day if the price stays the same. And which, by the way, towards the end of its life, towards the end of the expiration, is closer you get to the expiration, the faster and the greater the theta.
yeah,
becomes.
yeah.
I
So,
think the chart was like this. Like that, and this is the expiration. It's like this. There's like, as soon as you hit a certain limit. Things like. usually
but
3
so
weeks.
let's say the 390 is cheaper, right?
390 is cheaper, yeah,
Right.
yeah.
But the delta, no, the
So the
delta
reason-
is,
So the reason we do not. So if you think it's gonna go to 390. And it touches exactly 390 by the expiration. Well, then those contracts are at the money and they have no intrinsic value and they go worthless. So you essentially lose all of that, all of the value. So $360 is gone. That's why we want to go with 400, because that way your puts are in the money and they still have intrinsic value.
oh,
Why are the 390s not in the money?
The 390s, because these are puts, so it's out of the money, because you see the price is 410.
Oh, okay.
Yeah, so it's like flip.
yeah,
Yeah, and so,
But isn't 400 and 405, aren't they also out of the money?
you said 400?
Like, yeah, 400,
Yeah, no, 400 is out of the money.
those are all out of the money.
Yeah, they're all out of
Because
the money.
that's
I'm talking in terms of, if we go to 390, like exactly 390, those will be in the money.
Right.
Right, yeah, but those will be at the money, which still hold no intrinsic value.
Yeah,
could you move down, let's see the 415 put,
So those are going to be worth even more. So the 415 put is worth
11,
11, let's just say 1120. So the intrinsic value that those hold isn't also all that great. It's only $300. Or I'm sorry. Oh, yeah, 400, 450. $450. That's the intrinsic value. So the rest is all extrinsic value.
So if you buy, you buy 100 shares at 11.20 or whatever, and it hits 415, you make the difference, you make the or
So, okay, so if these are puts 415, so currently right now they're in the money. So they have some sort of intrinsic value because they're in the money.
let me think, it doesn't make sense. Because now it's 11, so it'd be 1,000 for one contract,
Yeah, right now.
1,100,
Yeah, it'd be 1100.
and
for
then
one contract.
minus 500. Right, because we're making $5.
I was gonna say teaching is its own skill. Being able to explain is its own skill. I just read it. Because I can't it's so hard.
Yeah, so what does that mean, the 415,
Okay.
413?
Right, price that.
Yeah, it's 11:15, right?
I will
So-
say, by the way, trying to learn calls and puts at the same time will just confuse the person because they're like inverse, they're flipped.
Yeah,
So, for example, this is all in the money, while this is all in the money also. So it's like flip.
yeah, that in the money because we got the put.
Yeah, they're in the money because 415 is above the current price.
Yeah, so it's $5,
$5, yeah.
500.
$500 is how much value those hold. So the other $600 is completely extrinsic value. That's just premium. That's just how much people are willing to pay.
Right.
So let's say you pay 1,100 for this, right? And it goes to 390. The SPY goes to 390. those will be worth. Those are 25, those will be worth $2,500, so you'll make 100% on those,
Okay.
if it goes to 390. And the nice thing about those is they still hold intrinsic
So you actually,
value,
so you actually just, you lose $600 if it
if it stays exactly the same, yeah.
And how,
and
what
of
if
course-
it go up?
What is it you have, so you have a month, essentially a month, and like 10 days. For it to make it smooth.
Okay.
You have a month with 10 days for it to make smooth to, which is $20, which is a good amount, you know? But we see SPY do well. That's why, to me personally, I try to stay away from SPY because the contracts always look like this. It's kind of crazy. So it's very, like, I'll show you, for example, right now, AMC.
Yeah,
You can find these, by the way, on all types of stocks, like, because by the way, SPY gets so much daily volume and
Yeah.
there's so many people trading it and institutions. That's why the contracts look like that. Okay, so this is January 25th. Or January
2 years.
17th, yeah, 25, so that's 2 years, right? So you see the $5 call, so let's just say you get it for $2.30, okay, because that's the bid and ask, so let's say you buy in the middle. $2.30, and the current price is at $6.50, okay? So this holds essentially $1.50 in intrinsic value. Because this is $5
oh,
strike.
okay.
So it holds $1 and whatever the difference is, so $1.45 in intrinsic value, and the rest is all extrinsic value, so you have, what's the math on that? $1.30. Let's just say an extra dollar, okay, so you have $1.30 intrinsic and $1 extrinsic value, okay? But now the nice thing is, you have 2 years. You have 2 years for the stock to go in the direction you want. So that's the nice thing about like certain options chains will have this nice benefit. Like you can look, by the way,
So-
you can see this $10 call, right?
Yes,
Is you have to pay $1 or $100.75. $100.75. Oh my goodness. Yeah, $175, okay? But you can see it's not worth it to buy this because now you have $10 straight. So this is $5 more out of the money. You're still paying a good premium, but this is all extrinsic value. While you can go with one where it has nice intrinsic value.
Below 650 for the money.
Yeah, yeah,
And-
below whatever. So anytime that's in the money, you look at the stock price, anything below for the calls is in the money.
Yes,
At the money is
more
when a
expensive.
call is literally just at the exact price. That's called at the money.
so if that's the case, if you are buying the one that's
The
at
$5.
the $5
Mhm.
one, what's the scenario that you will lose money
So the scenario that you will lose money,
when you go down to lower than 5?
yes, well, yeah, you will lose all your money in that case, but let's say the stock stay to 650 for the next 2 years, it does nothing, then your calls will be worth $1.50. Because that's the
Yeah,
in the money, how much it's in the money, so the difference. So that's why, like, you can find these on a bunch of different stocks, there are a lot of stocks that people don't pay attention to. Once again, like, these are also identified as more risky, because, for example, AMC, they probably have money issues and all types of other things going on, so it's
and so
hard.
what if in 2 years it's gone?
They choose
Bankrupt.
those people, yeah, everybody just losing their money.
Okay,
It's the same as, same as if you're holding a stock.
yeah,
If you go bankrupt, though, you lose your value, right? But I was gonna mention something else, I forgot. There's a bunch of different things that influence the options price too, that sometimes you'll just look at it and say, this is ridiculous, like, I'm not paying this much, that's called implied volatility. So what happened is, if there's like the people, market makers, broker dealers, all of them, they're expecting like a big move to come. What you'll see is applied volatility start to pump the move. Those will make contracts so outrageously expensive that if, let's say, on a normal day, that certain unit will make this amount of money. On that day where the implied volatility is pumped up, you won't make as much money because they pump the contract so high
Right.
that it's ridiculous.
Yeah.
So Like, for example, see how much, so the $5 call right now is worth 230. Okay, now watch how much that same $5 call is worth. Let's just pick a table. So you see how much it's worth? That five, so this expires literally in a couple months.
Yeah,
The other one expires in 2 years.
yeah,
But you see the only price difference is $40 between the two. So
Yeah.
which one would you rather pay for? Would you rather pay one, give yourself way more time?
yeah,
Yeah, give yourself way more time. That way you can sit there, and all you need is just one move, one earnings or one whatever, and you've already made all your money. I actually did that with marijuana stocks,
which
I-
one? Access.
Hexo.
Oh,
I sat there, man, for so long, okay? Because I bought 2 years out. 2 years out, little above out of the money. So that was still a little risky.
Right.
I'm still losing money on that.
So marijuana, oh
Yeah,
yeah, they're being hammered. But
Yeah.
I sat there, but the second it made its move, the second had a nice pump. I was profitable instantly.
Right.
So that's the nice thing about these. It's so much nicer, but you're gonna feel, you're gonna feel like, feel bad when you could have bought earlier date and made way more money.
Right,
You know what I'm
yeah.
saying? But that's the trade-off that you gotta give.
Right,
It's either you buy that or that, so.
exactly.
But, the delta, implied volatility, all those things, they matter a lot to these.
Right.
But like the main thing is, this is used for people that just want to leverage their position, to be honest. If you have a large stock portfolio and you just want to hedge for the downside or the upside or whatever it may be in the short term, then that's when you want to buy options. Or if you have really like a couple $1,000s to play with, that's when you want to do options too, because that's where you're, like I said, right there, like it could change exactly how you make money.
Right.
You know, but also your money can disappear very, very fast,
Right.
very, very fast.
look at YANG,
YANG,
young.
the currency,
The YANG is
this one right
the,
here.
yeah, the opposite of the Chinese. Can't see this, this is too dark. Oh, I didn't know we can do that.
Yeah. So 699, so it's following the
But
no, nothing, it looked exactly like AMC's recent run.
really,
Yeah,
so do you think AMC will go up? So this is the opposite of the Chinese related stock. So their opposite is, this is the short, so the long is YING, yin and yang. And because of the balloon thing, this one started to
oh,
go
the
up.
balloon,
Yeah,
were you guys here for the, no, they weren't here, it was just, who was here last time? Yeah.
she was here.
No,
Oh,
when I
you
was,
should have got Anthony.
when I was explaining, do you know, like, this is a trick that you guys can use at home, this is free money, okay? This is like.
Okay, yeah.
This is free money,
Oh, wait, make sure you share the, I think you are. Are you sharing this screen?
yeah.
Okay.
So AMC, by the way, I've been using this for literally every time. ETC or
Yeah,
AMC has an indicator telling you when it's about to pump. I'll show you that right now. So you guys can make, this is where I buy my options honestly, because that's like the safest bet for me. This is almost guaranteed. Okay, you see this chart?
Mhm.
Alright, you see something?
Yeah, it looked pretty
You can-
similar.
you can-
Okay, but here's the thing, they don't follow each other. There's one that runs before the other one, and that's Ethereum Classic runs before AMC. And I've literally been now. Mind you, like I didn't know about this one right here, that big jump right there. That's when I found out about it. I was like, wait, this is so weird. But this one, this, even that one, this one, and this one, all you could have gotten in before. But I wasn't paying attention to this one, this most recent one, that was my bad, because that was an easy 1000%. Got it, but like I just showed you with those options over there.
How early does it indicate?
Okay, yeah, I'll explain that right now, watch.
Is it 3-4 days, right?
It all depends because it all depends when the Ethereum Classic stops its run. So for example. Okay, so you see here. So January 4th, it starts its big run, right?
Yeah,
And it goes all the way. So January 10th, right? Like that's the first leg.
mhm,
Okay, and if you go here, back to MC. See January 9th, January 10th.
mm,
That's when it starts its run. Every time, think of it like this, every time Ethereum Classic stops its run, that is when AMC begins its run. So you see it right here, right? Jump.
So the 11th to like the 18th.
Yeah, 11 to the 18. But you see what I'm saying though, like when one stops, when Ethereum Classic stops its run, and it does its move, and as soon as it's done, right, which you can't really tell, like you just gotta get in, honestly, when you see, oh, Ethereum Classic is up 40%, oh, I'm for sure getting in, because I know AMC at some point will run 40%. And that's the only risk, is you don't know how long, like back in June, when AMC did its big run, Ethereum Classic took like a month for it to do its. So if you got in and you did only like a week or 2 week expiration, you would have lost all your money. But okay, see this one right here? So this is this one.
You know what you should do next time?
So you see how it says, oh, I'm sorry, go ahead.
No,
I
as in
didn't-
next tomorrow,
Uh-huh.
maybe show us how do you do this? Like, what do you need to click to
Oh.
move the chart?
With
You know, the
trading
very
view,
basic.
yeah, with trading view, it's different. It's much nicer with trading view. With your swim, you have to click on the icon, and, but I'm sure there's like if you can shift or something like that. But I just
Yeah.
don't, yeah, I don't. But you see how it says the 29th right here? And that's like the top. You see right here, 29,
29th,
Yeah.
right before it starts.
right? So
Yeah.
let's say, so you already know that AMC is popping off. Okay, cool. Now we got this one. Now watch this one. Now this one, I got in because I was impatient. I got in here, right? My position was down, man, like 70%, okay? I was mad. But then I saw Ethereum Classic running. Oh, I got so happy. I'm like, I doubled my position down, and then this happened. I made 1000%. Now, mind you, my position should have been down 80%. So we averaged down a lot.
Yeah,
So this one, you have to be faster. Okay, so this one, March 22nd. You see that's the high? March 22nd. See that? So if you would have bought at March 22nd in the morning, oh, you would have. It's 150% move. On a stock right there, you know, that's not options, that's a stock. On options with those, with the thing, you'll make a little more. Okay, let me show you this one. Let's just pick this one, August 15th, see the top right there.
mhm.
Have you been trading IMC for a long period of time?
Yeah,
Like it's your favorite stock?
it's the most guaranteed for me, in my opinion, like you see it right here, it's free, like.
You know
just
the-
So you see August 15th, that's when it starts with run,
you talk about
And the
the
run usually happens
psychology,
in a couple
right?
days, right?
what happened?
Psychology, the investment psychology.
Yeah.
So that's like that. I believe a big group of people are like him. When they see this, when they expected that, people going and then it will go up.
Yeah.
But
So-
yeah, that run usually happens for a couple days.
Oh, yeah, it all depends on how,
Right.
Yeah.
But you don't know exactly when it's gonna stop its run and all that, or.
well, actually, on the moves look pretty similar, and if you measure whatever the Ethereum Classic move was, AMC is also very similar, because the reason, like the expected reason, or like, the reasoning why they're doing this is because the market cap of both of us, both AMC and Ethereum Classic are exactly the same. Like, if you go look right now, they're exactly the same. So for the most part, depending on what run it is, or what day, month, whatever their market cap is, you'll be able to measure what the percent move is going to be. But now, what made it difficult is not how they split. So now there's 8 and AMC.
Yeah,
It's made it a little more difficult, but it's still, like, it still plays the same way.
We'll see next time. If it will go up. So when you know that you still do options, you buy
Yeah,
calls.
that's the best, that's the best option. Like, you don't wanna throw that, this happens every maybe 3, 4 months, 5 months. You don't wanna throw it away on just buying 200 shares, 100
Yeah.
shares. You know, you could, but look, that $500 can be 1,000, 2,000%.
Damn.
Like that little 40% move, 50% move, those options did because of high volatility, which
Yeah.
I hopefully we'll get more into like next time, those went through. the roof. So not only did the options move, but also just the hype that were around those contracts, just pumped those contracts even more. So they just went really. Trying to show you the big one, man, but like, just asking. This was the most interesting, and if I knew it back then. Well, obviously, would have made a lot more money, but.
Trading view, okay. Looks like trading view is very easy to maneuver.
Oh, yeah, I love TradingView. It's also like less laggy,
Yeah, it looks very fast.
yeah. Okay, watch this. If you're not convinced, this is gonna convince you.
This
So-
is-
So I remember when this, my father was in this, by the way, but I just had it in crypto just because I love crypto and there's a huge crypto cycle. And I was in this, like, I just saw my father's portfolio just keep going up. I'm like, all right, yeah, it's settled. And I think it sold at literally like 110. So not exactly the top, but almost.
right.
So sold at 110, but anyway. So you see this run, whatever. So you see the top right here, May 6th. Okay, so you see the pattern, jumps up, back down, and then pumps. All right. It's right here.
6.
Okay, look at this.
Oh,
All right, see that, May 6th?
Uh-huh.
Look at that. Does this little pump, comes back down, all the way up. And then, of course, it goes sideways.
Weird.
It's so weird. Oh, and by the way, these are also accounted for too. This one and this one. So it's the same way, like I can go back and do it too.
I have a meeting, so
Okay, that's fine.
when you're done, make sure you
Just put everything out.
close this.
I mean, it's 3 anyways.
Yeah.
You see these 2, right? This one.
yeah,
So this one, January 10th. Go too long. So let's just say you got
that little,
January 11th. So you would have just been in that ride the whole time.
right,
And the same thing here. So you see the top right here, February 13th.
remember that one.
Well, yeah, because this is the weekend. So either day, it doesn't even matter. There you go. You got that move right there. So you literally have. That's what I'm saying. Like, you can go home and look at it, but I think this is so interesting. Like, there's no other indicator. And it's almost guaranteed. That's why, like options is risking a lot of things, but like this one, you
Right.
money.
Really interesting.
Nah, it is. It makes you got like wonder questions and stuff.
Well, yeah, 100%.
Even though I don't figure out, or I don't know why it's happening, guess what? You know, I can sit there and make money off. it.
Yeah,
I don't need to know exactly why.